Sectors to watch in 2023, Part 2. This is a follow-up to our Part 1 from last week, which we profiled 3 sectors that caught our attention, which were carbon gold and cybersecurity, with the first 2 at the top of my portfolio in terms of position size. This week, I'll detail several other sectors our team is researching and analyzing closely for hidden gems. Lithium. Lithium is an interesting sector, and by now most investors know this is a critical element in a net zero world. When you think batteries, you think lithium, and the world will need a lot of it. But it's also very abundant. Economic concentrations of lithium in mineable jurisdictions is the key. Look at the intense hockey stick price rise in lithium. Also caught the attention of the investors. In 2021, lithium prices in China rose 400%. Then in 2022, prices nearly doubled again, finishing a horrible year for most commodities, up 80% for lithium. And it was one of the hottest sectors in 2022, even though it didn't catch much mainstream attention. The demand for lithium continues to soar, and the projections show demand forecasts increasing up by 10 times by 2030. Look at the lithium demand forecast in this chart right now. Elon Musk expressed his desire for easy-to-reach, local US-sourced lithium, and this ignited the fire on many lithium stocks. Tesla is building a lithium refinery on the Texas Gulf Coast. There are 4 major companies that run most of the world's lithium production. Think of them as the OPEC of lithium. But there are many companies vying for a slice of the growing pie. Why I like the lithium sector. Battery chemistry changes every day, but lithium is critical as a battery metal and demand is poised to grow significantly. And it's a very light metal. Ironically, when I first wrote this sector up in 2009 and delivered a 20-bagger for my investors, we talked about the medical uses of lithium. And if you look around you, you probably won't argue that, there's probably more crazy people in the world than there were a decade ago. How I'm playing it. Musk calls lithium refining, you can't lose. It's a license to print money, end quote. Exploring for lithium and producing lithium is a different game than refining lithium. And be very careful when you're putting your money into the sector. There are plenty of companies with empty promises, and it could be hard for the regular investor to tell the difference. Most lithium companies and small cap companies have projects that will never get permitted or never get built because they're not economic. Be careful and stay away from those. A previous lithium company we waited like alligators to buy, here's the link, highlighted several years ago, got bought out at a significant premium. We're well versed on the sector, we do the site visits, and have visited several projects in the Americas. I have a handful of assets on my radar owned by companies that could make sense if the price and valuation is right. What to focus on when investing in a lithium exploration company. Management team, people, and insiders that actually know lithium and have successful experience in the sector in the past. Avoid those who are unblemished with success. Remember, the insiders who know the game are able to get capitalized and the money to do what needs to be done. Everything starts with good people. Just like in all my other projects, grade is king, always. Metallurgy is queen, always. Jurisdictional risk. Why increase your risk with political risk when there are incredible ultra high grade deposits in safe jurisdictions with existing infrastructure in place? Another one, digitalization of previous exploration. This is not the first lithium exploration boom. It's happened many times before. A proven success strategy I have deployed for over 2 decades is actually very simple. It's taking old data on the highest grade deposits with previous work, which I call OPM, other people's money, and digitalizing using the modern technology to better define the exploration potential. There's going to be some big scores in lithium in 2023. The next sector, green hydrogen. This is something investors are going to see a lot more of starting in 2023. The most abundant element in the universe, other than stupidity, of course, is now setting itself up as a critical spot in the green revolution. Since being used to lift blimps in the 18th century, hydrogen-based technologies have come a long way. Two of hydrogen's unique attributes are, the first, ability to be stored and used as a clean fuel without direct emissions, and the second, obviously, is the flexibility and versatility as a fuel. These properties provide an opportunity to solve the critical decarbonization issues faced in hard-to-abate segments, things like cement and steel and heavy transport industries. Solving these problems have the potential to lead to a massive increase in demand if, and I said if, we can get the technology right. Today, the majority of commercially produced hydrogen comes from fossil fuels, primarily natural gas and coal. Bet you a lot of people didn't know that. In order for hydrogen to go mainstream, hydrogen production will need to go green. Green hydrogen is produced through a process known as electrolysis. Today, this process makes up less than 1% of global hydrogen production, so it's still super early days. Over the coming decades, I expect this to change as economies of scale and technical innovation drive down costs. And according to the World Bank, the demand for hydrogen reached an estimated 87 million metric tons in 2020 and is expected to grow to 500 to 680 million metric tons by 2050. That's almost an 8-fold increase. Now, this chart is busy and we didn't create it, but what it's trying to show is the potential growth in the market over the coming decades. But don't sleep on green hydrogen. As global decarbonization continues, hydrogen companies could become the new hot sector for speculative investors. We're seeing a growing number of deals and investor decks coming our way, asking our opinions and looking into each of them. Stay tuned as this sector heats up in the coming years. And one that I've got incredible experience and success in, uranium. Russia, together with Kazakhstan and Uzbekistan, make up 58% of global uranium production. Think about that. 58%. Yet the United States required 44% of global uranium production in 2021 for the domestic demand. Either the United States buys every pound of uranium outside of Russia, or Russia will continue to control US's energy security. Now remember, 1 in every 5 homes in America is powered by nuclear energy. The US government will not let that happen, and this is a major issue. And both sides of the political spectrum are accelerating funding and tabling bills to help revive the US nuclear energy industry. And never bet against America. Where do you think the technology that the Kazakhs have benefited from was created? In the US, decades before. Did I mention that nuclear energy is critical to reduce emissions and get to 2030 net zero plans and projections? China, India, and Russia are building a large number of reactors. Saudi Arabia is just announcing that it's going to announce its commitments. Europe and Japan are restarting dormant ones. Why I like this sector. The nuclear scare of Fukushima is over and the tide is turning quickly. The world and investors and governments are recognizing that nuclear is an all-important baseload form of energy with much lower carbon footprint and overall cost and dependable than other forms of energy. Demand is going to increase big time. For example, 4.6% of China's electricity comes from their 48 operating nuclear reactors. They want to get to 20%. I've always stated in both books, it's a diversified energy matrix. Ironically, America also has 20% of their production in nuclear. But China will need another 150 nuclear reactors. That's just China. How I'm playing it. I have a handful of uranium companies on my radar, but I'm staying away from the rinky-dink, high-risk exploration in risky jurisdictions. And look, stay away from the guys who are running multiple deals with no experience in uranium. You want to look for pure play uranium companies that are trading on large US exchanges where the big ETFs and the large funds can access big positions, not companies that trade by appointment. Otherwise, you're playing with a pack of matches that burn bright and fizzle faster. Now look, people want to know my opinion on oil. Even with a massive anti-oil push from decarbonization, oil was one of the top performing sectors in 2022. Producer diligence both in North America and abroad has led to a tight supply-demand fundamentals, which in turn has supported higher oil prices. Tight fundamentals are likely to continue and beyond this year as fossil fuel companies face higher cost of capital, which will curb excessive spending. However, even under the most aggressive of decarbonization scenarios, oil is likely to remain a key commodity for the coming decades. The transition away is real, but we've been reliant upon fossil fuels for over a century, and substituting away will not be an overnight success. A key theme for oil companies in 2023 and beyond will be mitigating greenhouse gas emissions, especially methane. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.